Does it feel like you need a huge pile of cash just to start investing in top companies? For years, that was the reality. If a single share of a company like Amazon or Google cost thousands of dollars, new or smaller investors were simply locked out. But the rise of fractional shares changed everything, letting you buy just a slice of a stock. While many brokers offer this now, they don't all do it the same way. Today, we're diving into what makes M1 Finance's fractional share pricing and model fundamentally different from other popular brokers. The core difference: how M1 invests. The biggest comparison point isn't about a few pennies on the trade, it's the entire investment philosophy. Most brokers, like Fidelity or Robinhood, use transaction-based investing. You decide the security, you enter the exact dollar amount or fraction, and the trade executes immediately at the current market price, often called real-time trading. This is great for active traders or those making one-off buys. M1 Finance, however, is built for automated, long-term investing. It uses a single, designated trading window each day. Why does this matter for pricing? M1 Scheduled Execution. M1 pools all of its users' buy and sell orders for fractional shares and executes them all at once during that window. This method is optimized for efficiency and automation, ensuring your money is invested according to your preset targets, known as pies. Because the system is focused on portfolio management, the pricing is the uniform, official market price at the moment of execution, and there are no trade commissions. Other brokers' instant execution. Brokers that offer instant, real-time fractional trading have to handle a constant flow of small orders. While they also offer commission-free trading, the price you get is the exact market price at the second you click buy. The key difference here is the focus. M1 is about automated dollar cost averaging into a diverse portfolio, while other brokers focus on the immediate trade. The price of access, minimums, and flexibility. When it comes to accessibility, the differences are subtle but important. M1's focus on the dollar. M1's fractional shares are all about dollar-based investing. You set a dollar amount for each slice of your pie, and M1 automatically calculates the fractional share you get. It's perfect for true dollar cost averaging where you're consistently putting a fixed amount of cash to work across a basket of stocks. The minimum investment is usually very low, often just $1 per slice. Other brokers' flexibility. Other platforms like Fidelity also have low minimums, often $1 per trade. However, their primary experience is still built around manual trading, giving you the flexibility to choose between buying a fraction of a share, a full share, or a specific dollar amount. You have more control over when the trade happens, but you lose M1's powerful automation features. In short, M1's pricing model for fractional shares is a direct function of its automated, portfolio-first approach. You trade immediacy for the power of set-it-and-forget-it investing, which, for long-term investors, is the real price benefit. With that said, thanks for watching and until next time.